Hello and good day, everyone. My name is Dirk Kronsager. I am with Deutsche Bank's product management organization in Frankfurt. I'm excited to speak to you today here about a topic which we understand is very close to the hearts of many corporates, which is to look at ways to become more efficient at reconciliation, especially in the order to cash process. Now, first and foremost, efficiency in order to cash. Why is it relevant? From talking to corporates in various countries and regions, we found that there are four main aspects why this is important and relevant to corporates. First and foremost, there is the topic of operational efficiency. By that we mean, how can corporates use technology that is nowadays available in order to automate or digitize their accounting processes. In this context, what we also see that cash application, so the matching of individual items in the bank account statement to individual invoices in the general ledger of the companies, can be a very burdensome and manual activity. This is especially so when we talk about transactions in the B2B space. But also, when looking at employees and employee engagement, what we have seen with customers who have embraced this topic and who have deployed available technology, what these customers have realized is that the moment they have started and bedded down these new technologies, they have been able to assign their employees to focus on other activities or process optimization more broadly. Secondly, there is, of course, a working capital element attached to it. The ability to faster apply your receipts to the receivables ledger obviously allows you to better utilize your customers' credit limits. And you do not have to reallocate valuable credit limit in a suboptimal manner. As an extension to this thought, there is also an opportunity for enhancing and increasing revenue with your customers, because the faster you can apply cash, the more likely it is that you can generate the next sales and therefore revenues with your customers. The third element, which is customer centricity, is mainly gravitating around two aspects. First and foremost, there is the credit management side of things, which means that the moment you are automating, digitizing your cash application process, you are ultimately achieving better and more accurate credit decisions, which in turn can lead to higher customer satisfaction and engagement, because stating the obvious here in a way, the faster you are turning around payments, the faster you are applying receipts, the more likely it is that your customers will return and do incremental business with you. Lastly, and this is something that we see in more recent discussions with corporates, we also notice that a faster cash application process can be a key requirement towards new business enablement. What do I mean by that? We do see that certain corporates are looking at ways and opportunities to leverage, in particular, the availability of instant payment schemes in an increasing number of countries across the world, as a way to tap into new business opportunities, as a way to tap into new business channels, sometimes by disintermediating distributors. At the same time, however, realizing new sales via new channels shall not go hand in hand with increased resource requirements or even a higher resource intensity for credit management related processes. So that is why these corporates are, on the one hand side, looking to realize additional sales, tapping into new business opportunities, but they would not want to create the additional overhead that this may create. So in combination with instant payments and the finality that these transactions can bring, it is a very integrated way of achieving high, if not highest possible automation rates, but at the same time being certain that because of the finality of payments, there is absolutely no need to deploy additional resources. You can achieve a very nice and efficient straight-through process on the reconciliation side. Now, how does it work in practice? If we take a look at the next slide, I think all of you, many of you will know that very often the problem is not so much to understand who has paid when you look at your individual bank account statements, but the bigger problem tends to be what has this particular payment been made for? And that has very often to do with the fact that by looking at the information that is available from the bank, or more specifically the bank account statement, it may not always be self-explanatory what are actually the invoices that have been paid, which invoice has been paid in full, which invoice may have been paid with a discount, which invoice may have been disputed. And to make things even more complicated than they already are, we also have situations where there are credit notices that are getting offset against invoices due. Also, what we do see, especially with diversified companies who are selling to a mixture of business customers as well as retail customers, respectively companies that tend to be present in multiple countries, what these customers have in common is that they are receiving data from a multitude of sources. For sure, they would see information from the bank account statement, but they may well receive other information that is relevant for reconciliation purposes through means of payment advices. If we think about the B2C space, there may be payment service providers who are providing lump sum credits, but at the same time, our customers need invoice level detail to understand which invoices have been paid by which customers. To make things even more complicated than they already are, especially with larger organizations, what we also see is that across an organization and across a geography of countries, it can become very complex how the individual workflows at an entity level or at a country level are essentially working. So it's the combination of these things that define the problem, and for which we have found a solution that can help customers address and ideally overcome these challenges. Now, how does it actually work? The solution is characterized by three key process steps, which I will go through in combination. It builds on what I said in the beginning. The problem I think we have defined and described to quite an extent. Now, in terms of the actual solution, how do we address these aspects of the problem? First and foremost, the way how this solution works, the receivables matching solution, is that the first step is really about bringing together and aggregating data that have been processed by the bank, together with data and information that is traveling outside the banking system. Think about payment advices that come in via mail, via email, or maybe even via fax. So it is about really importing and aggregating these data, and then merging these data, bringing them together such that you have the bank statement data on the one hand side, you have other data sources on the other side, and the combination of the two will give you a data set that is not only comprehensive, but that is also structured and available in an electronic format, such that you can then push it over into your ERP system in order to perform invoice level reconciliation. And that is exactly what you can see on this visualized overview, this high-level schematic overview here on the right-hand side of the slide. It is about bringing the data together, merging them, and making them complete, meaningful, and relevant for reconciliation purposes. And once you have then these complete data sets, you can push them over into the SAP system, and that's where a set of rule-based reconciliation criteria will be applied in order to determine which particular item based on the supplementary information is relating to which open invoice on your ledger. Because it is based on electronic data sets, as I said earlier, it provides you obviously with high or higher automation rates. You could think of even on a near real-time basis. I go back to the example of instant payments. You may well say that instant payments for receipts from your customers may not be as relevant, but I think it's fairly predictable, most certainly in the B2C space and also foreseeable in the B2B space, that the adoption of instant payments is going to rise. Now, why is this relevant? This may become relevant because the ability of your customers to be able to pay via instant payments may translate into a requirement for you to process this information on a faster basis. I wouldn't want to go as far as to say on a near real-time basis, but the expectation is likely to be into the direction of you processing these items faster than you may have done in the past. And that can ultimately drive faster fulfillment. So the information that your customer has paid, the invoice has been paid in full, the goods can leave the warehouse or the services can be provided. This is something that can be expedited in a much faster manner than presently is the case, where batch processing tends to be still the norm that prevails across a large number of industries. When you extend the view beyond the initial or the immediate task at hand, which is to perform the operational activity of applying items from the bank account statement to your receivables ledger system, this is the first step that obviously needs to be completed on a day-to-day basis. But over time, what it will tell you and enable you to do is to leverage these data to gain some insights into collection patterns, respectively, what are your customers' payment patterns? Which of your customers have a change in payment pattern? Do you potentially foresee a deteriorating trend in that customers are using or even exceeding payment terms when they may have paid within payment terms in the past, just as an example? Would you see a shift in payment channels from one particular transaction type to another? As an anecdotal comment or a feedback that we are seeing with a lot of customers, especially in the post-COVID days, if I may say so, is that the customers are rethinking whether they are still accepting checks, for example, as a payment means, or conversely, whether they are still paying their vendors via checks as they may have done in the past, at least in certain countries, even here within Europe. And that's for obvious reasons, because at the peak of the pandemic in Q2 last year, what we definitely have seen that, be it on the collection or the disbursement side, checks unfortunately and literally have been stuck in the mail, with the obvious consequences on your supply chains, respective on your liquidity. So these are also things which are obviously then becoming possible the moment you have these data insights into your collection patterns or your customers' collection structure, your customers' payment behavior, and any changes there too. Now, to make this a bit more tangible, what we have taken here is a before and after comparison, which is taken from a live customer example to illustrate the point. And before I go into the details, I think one thing needs to be said here quite clearly. Every customer is different from another. Every customer has a different invoicing pattern. You may have different collection volumes. You may have a different structure of your collections. By that I mean, is it entirely predominantly domestic? Is it mostly cross-border? And you may have different payment patterns of your customers. Are they bundling multiple invoices into single payments? Or are your selling relationships and your invoicing patterns more a kind of one-off transaction? So these are definitely factors which are driving differences from one company to another. But just to take this example here from a live customer implementation, this customer was processing round about 2,200 items per day. The automation rate was merely 10%, meaning that there were about 2,000 items that needed to be reconciled on a manual basis every day. And that translated into an overall effort of round about 100 man hours with an assumed and implied effort of 3 minutes per item. Now, in the post-implementation scenario, we have been able to achieve that, to increase that automation rate from 10 to approximately 75%. I think 100% is of course a very desirable goal, but one needs to be realistic and factor in the fact that there are always reasons and circumstances that may prevent you from getting there. But even if it was just 75%, like in this case, at the end of the day, what this has translated in is that the associated manual effort could be reduced from round about 100 hours down to 18 hours on a daily basis. So it's round about 1/5 of the resources that were deployed against this activity compared to previously. So in order, if I may summarize, why should corporates consider this now? I think, like with a lot of things in treasury and cash management, the fact of the matter is that what used to be significant hurdles or barriers in the past, especially around affordability of existing technologies, those barriers have come down significantly. The underlying technology that we are using and offering here is already live, proven, and tested with 400 mostly multinational corporates from across the world. Very key, especially from the vantage point of how future-proof will be my investment today, especially since we talk a lot these days about migration from earlier releases of SAP onto the new S/4HANA technology or platform. You'll be pleased to hear that whatever would be implemented right now here and today, even if it was on R3, is future-proof insofar as it can be seamlessly migrated over to S4 HANA environment. So in other words, no additional migration efforts is necessary, which gives you a high degree of certainty that the investment, even if you were to take it now in R3, will not be gone. Quite obviously, as the earlier example was meant to illustrate, it is a significant lever for reducing cost of finance, which remains on top of the agenda of every CFO in every organization, big or small. As I alluded to earlier, it is definitely a means to not just increase employee satisfaction, taking people away from more repetitive activities and reallocating resources to more value-added activities. If you think about ways to more systematically analyze your credit and collection management practices, that would be one thing. But also the point about increasing customer satisfaction, increasing client delight. The moment you are receiving and processing cash faster, you are fulfilling your orders faster than you may have done in the past because you bring efficiency and automation to the overall process, the more likely it is that your customers will be even more satisfied than they may have been before. On top of things, what is very key to implement, what is very key to highlight in context of the implementation here is the fact that this solution is fully integrated with a corporate SAP environment. So in other words, it is not about fetching data from your existing environment, uploading, exporting it into some form of a cloud-based, externally hosted system or application, where then reconciliation is being performed and a processed file comes back for consumption by your SAP system again, this solution is plugged straight away into the SAP environment. It is an integral part of the SAP environment, and no data is getting processed outside the client's environment. So I hope this was useful and insightful and provided you with an initial insight into how we at Deutsche Bank are taking ways and measures to take our cash management offering beyond the more traditional means. And if I may say so, our job doesn't stop where we provide our customers with electronic bank account statements or electronic client reporting. We have taken this a significant step further by extending the view into your own ERP environment, into your own finance and accounting teams, and looking at how we can extend the value that we can create beyond what we are presently doing. With that, I would like to conclude this presentation right now, and I'm happy to take questions from the audience. Thank you.